Hello, everyone. Thank you for joining us for our webinar today. Today, we are going to be talking about why you need a retirement income strategy. So, we're going to go over all of the little things about it and our exclusive retirement income strategy that we have here with Cetera. So, if our advisors would like to introduce themselves.
Sure. Hey, everybody. Good afternoon. Thanks for joining. I'm Stan Malecki. I'm the owner here of Malecki Financial Group. I specialize in working with, with business owners and exit planning for outdoor living business owners. I really enjoy working with those folks.
All right. Hi, everyone. My name is Eric Stiles. I'm a certified financial planner. I help the Garden State retire early with exclusive retirement income strategies.
Okay, let's get to it.
All right. So this first slide, it's a nice chart showing the S&P 500. That is the follows the U.S. stock market. For all intents and purposes, this shows the U.S. stock market performance going back to 1996. So the stock market has its normal ups and downs, and Anastasia, if you can start, clicking through, you can see the volatility can go up, 106, down 49%, up 101, and then down 57%. Then we had, so that right there was the lost decade. Over that decade, technically, the U.S. stock market did not make any money. But then we went on to the longest running bull market the U.S. stock market has had. But what we're now seeing today is we're kind of seeing back to that choppiness, back to that volatility. No one can accurately predict exactly what's going to happen in the markets on any given day, week, month, or year. We can make assumptions, we can make predictions, but we don't know actually what's going to happen until it comes through.
So, knowing that volatility is there, why is a strategy actually necessary when it comes to taking your retirement income? How is that related?
So let's take a look at this. So this is an example of 30 years. We're looking at a 60-40 portfolio of equities and bonds. Okay, so like a balanced strategy. And we're looking at this, looking at different withdrawal rates over that period of time. And we like our clients to kind of be in that 4% range. So if you can see on the screen here, this is reflective. If we took a 4% withdrawal rate, in normal conditions, markets are doing well. We kick off a retirement income strategy, and most people, you'll have an 8% failure rate, is what that's showing there, or 92% of people could be successful at that 4% rate. But as you see, as you start to take out more income, you have less of an opportunity to be successful. So you can see the 5% withdrawal rate, and all of a sudden now is a 16% failure rate, and so on and so forth. So that's a very key thing that we talk about. We really want to stick to the right withdrawal rate, or you could run the risk of having a lot of problems and be unsuccessful. So now let's look at, this is a poor example, and we're starting off poorly. So that same 30-year period, you happen to select this year, and let's say the markets are down 25%. Look at the difference now of starting off drawing income in a good year versus a poor year. So we're looking at now a huge increase in drop of the probability of success. It's 22% of people can run out of money now versus that 8%, just because we started in a down period, and the longevity of that 30-year period, you're now running at a much potential higher negative outcome. So that's a lot of the reasons why we're looking at what we're going to be talking about today to help people be more successful. So with this, if we're looking at, so if I had 5 clients and we're all going to be doing income planning, and we were starting off in a down year, that's a 1 out of 5 of those clients are going to be successful, and that's not acceptable here. So we want to make sure people have consistent, durable income. So we're going to kind of go through this today.
Okay, to kind of expand on, all right, why, if year one the markets are down 25%, a bear market, a normal level bear market, why is that such a big deal? Like why is year one being down such a big deal and can decrease your success rate from if you're a 4% withdrawal person and a 60/40 portfolio from 8% to 22%. And so it kind of starts with, how the money is going in and out of your investments. So when you're in your working years, you're saving for retirement. Every paycheck, a certain amount is taken out and added into your investments. So over that time, you're going to be purchasing more shares of your in your 401k when the markets are up, when the markets are down. It's going to go in a different time. So when the markets are up and you're purchasing more, if you're adding the same dollar amount, you're going to be purchasing the same less shares because it's more costly to buy those shares. But let's say you're adding your money from your paycheck just systematically, and then the markets are down. You're going to be able to buy more shares for the same amount of dollars you put in when the markets are high. But eventually, it all averages out. So in that, the whole buy low, buy low, sell high investing scenario, yes, you're going to be buying high sometimes, but if you have the long-term horizon for your plan, and same for retirement, the markets have tended to, over the long term, always tended to, trend upwards. Even though you might be buying a high at one certain time, you may still have the opportunity for it to grow over the long term. So that's how it works on the in adding in side is that if you're adding in systematically every paycheck, eventually it's going to average out to a good cost per share that you purchased over the long term or a suitable one. Now, what not a lot of people talk about with dollar cost averaging is the opposite side of it. When you're done working, you don't have a paycheck anymore. You now are living off of the assets that you've been saving, this entire time. Well, kind of similarly on the adding side, you're adding money every paycheck, every month to your investments. Now, every month you're taking money out of your investments to live off of. That's your new paycheck. That's you, paying yourself to live in retirement. You are going to be selling shares during highs in the market. You're selling shares when the markets are at a low. You're going, but either way, you're trying to live off that same dollar amount. But when you're selling your shares in the high, you don't have to sell as much of your investments to fund that dollar amount. But when you're selling shares at low, you have to sell more of your shares to get to that dollar amount. So essentially, but the big difference is if the markets are low in that first year, 25% pullback, you have to sell more of your shares to generate those living expenses in that first year. But the difference is you are locking in those losses. You are locking in selling at a low. Well, once the markets recover, you're not going to get refunded for the fact that you had to sell at a low. Like, no, it's done. It's locked in. Because on the opposite side, when you're saving for retirement and you buy shares that are really expensive, you still have time at leading up to retirement for those shares to grow. But that's not the case on the back end. That's why that first year is so important because if you are selling more shares than anticipated because the markets happen to go into a bear market in year one, that is going to have a great effect on the longevity of your plan.
Very much so. Can I add something real quick to that? So just to Eric's point, now look, let's talk about that because now you're looking at over a lifetime, taking out income, each month, let's say, to free up and liquid. So what Eric and I do is we'll be invested in some strategies. And then like going back to that 60/40 portfolio, if somebody was just in something like that only during retirement, you're going to feel that fluctuation when we have volatile times like we're experiencing even this year and we're forced to sell in down periods. So that's what Eric just talked about. That just continues to compound. And over the next 30 years, let's say in retirement, you're going to be forced to sell in good years and in bad. And so we're going to be talking a little bit about how to try to avoid some of those pitfalls.
Okay, and so what we do to try to mitigate that risk and that concern of your plan being impacted in year one is we put your assets in generally three overall buckets: income now, future income, and long-term growth. Your income now bucket is going to generally be in safer investments, whether it be fixed income, whether it be a lifetime income from a guaranteed annuity. It's going to be less impacted by the ups and downs of the stock market. And so when we are selling shares to fund your first several years of retirement, we're more and more going to be selling shares of assets that shouldn't fluctuate as much as the stock market. So that kind of helps mitigate that risk. Future income. Eventually, our income now bucket is going to deplete. Future income is we're pre-funding, refilling that after several years. And then long-term growth, this is where the majority of our stocks will be held. And we're generally not going to touch this for about 15 years. And so we can go through years like this year, for volatility wise, years like 2022, and we'll be okay because this is a long-term asset that we aren't using to fund your income initially. And if we go on to the next slide, so we use five categories within these three buckets. We use lifetime income, fixed income, balanced, long-term growth, and income growth. Lifetime income and fixed income, that is in your income now bucket. That's where the majority of your income is going to be getting funded from. On the lifetime income side, we use contractual guaranteed income, whether it be from the various types of annuities, where we a variable annuity, fixed index annuity, whatever is going to be the most prosperous for your specific situation. And this is guaranteed for life for as long as you live. It helps raise the floor of your retirement income strategy. Fixed income is like what I talked about, where the majority is going to be. It's in bonds, it's not really in the stock market, and it should have a little bit of a nicer buffer. Balanced, like I talked about, this is the sole the sole category within the income later bucket. And this is getting ready to refill the fixed income bucket once it's depleted after about 7 or 8 years. So we get slightly more growth oriented, but still, not still have a hefty portion of fixed income in that portfolio because we are going to be using it in the, soon. Long-term growth, like talked about, this is your stock bucket. This is where we're focused on long-term, let it grow through the volatility that naturally happens over a market cycle. And then lastly, income and growth, another thing we call it as, this is your durable income. These are investment strategies such as alternatives or derivatives that are a little bit less correlated to your traditional asset categories like stocks, bonds, and cash, and are meant to generate a yield or an interest that you can live off of a smaller portion that'll be taken out fixed income. But we call it durable income because we do not intend for this bucket to be depleted over your retirement income strategy. We intend to live off of the interest, but also allow for the asset to still increase beyond that point. So those are the five categories that we use to fill the three buckets: income now, income later, and long-term growth.
Perfect. Thanks, Eric, for explaining that. So so now let's look at this slide. This is an example of the software we use because this is a mathematical equation of how much we want to allocate into each of these buckets that Eric just went through. So for example, you'll see this is a client. This is showing actually 17 years, but we're starting 2 years into this. So it's a 15-year kind of look forward projection of how we're going to take out income for a client. This is showing a $1.5 million investment account or multiple investment assets, and how we're going to allocate this to create the strategy for you to have that dependable income and things that we're talking about. So kind of that bucket one, or that one bucket would provide you that guarantee, is that lifetime income bucket that Eric talked about. You can see that's 20,700. It starts in year 3. It's showing these clients are now age 60. They're going to retire at 62. If you look over a little bit under that long-term growth bucket, you'll see money going in. They're actually adding money into the retirement and things of that nature. So we're starting in year 3 for this client to show a proposal, and it shows total income on the far right, by the way. And I know there's a lot of moving parts with this. To try to simplify, we're looking at about 65,000 of income for the first 7 years with this client from these amount of assets. So if we slide back to the left, lifetime income, that's contractually guaranteed by different annuity companies. If someone needs something like that, that's one of the buckets. A little over $20,000 will stem from that bucket alone. The fixed income we're showing here, that's going to generate immediate income of 25,200. And this is spending the money down. It's actually spending principal and interest down over the 7 year period. And if we keep sliding to the right, that balance bucket, that's the bucket Eric just talked about. We're not touching that for 7 or 8 years. We're letting it, and if you can see those numbers there, about 191,000 or so will be allocated to that. And we're not touching it. We're buying time. We're letting the market do its thing. And then we're feeding over the fixed income bucket in year 8. And we're now giving you, this is important. We're now trying to beat inflation and we're trying to keep up with cost of living. We give the client a bump up in income from 25,200 in that same bucket. Now it's going to be 37,200. So again, to keep up with cost of living. And I already mentioned that balance bucket and what that portion does. And then there's that long-term care bucket that you see on the screen that's in kind of dark purple. We're allocating approximately 400,000. That is going to be, we're not touching it. It's going to be more growth oriented, hence the name. And for 15 years, we let it ride and grow. And if you see, it's kind of projecting out based on this is net of cost to a client, what that asset class may return over time. And we're showing about a $400,000 starting gate that down the road, if you look at the very bottom, it says estimated after 17 years, that could be worth about 1.5 million in long-term growth that we could either have that go start again the next 15 years and reallocate for more income, more money to pass on a legacy to family, things of that nature. And then that far right bucket, we purposely and intently use two different strategies in this allocation, or two different strategies within that bucket. And again, that's that durable income Eric talked about, where sometimes I use an analogy with kind of a, we'll call it a agricultural analogy in a way where trees and fruit. This is kind of where we're trying to trees that can bear fruit, and so we want to try to get a high yield of crop and not try to touch too much of the or cut down the trees in this respect, but actually bear the fruit and just take the fruit and be able to have that growth and income strategy that we were talking about earlier. So you could see we're able to initially start off, it's a $65,000 income for the client. We bump it up to 77,000. And then at the end of the day, we started with about 1.5 million. And if you look at the far lower right, it shows us we have about 2.1 million now for the client. We have actually grown their nest egg, but took out all that income all those years for 15 years. So very powerful story.
Yeah, and one thing just to add in, so that first bucket, segment 1A, lifetime income, that is, I just want to make clear so everyone on this on here knows this, that is the only bucket that is guaranteed. All these other buckets, we are basing it off of a assumed interest rate of return. Obviously, that's not guaranteed as well, but we are using that, and we like Stan said, this is a mathematical software and that we've used and looking over past history for these capital market assumptions. These are rates that we hope to pursue. And kind of this is how the numbers could line up if those interest rates were do happen over the next, for this illustration, 17 years.
Mhm.
So I know we went over a lot. There were a lot of things in there. So, of course, we have an opportunity for questions to be asked. I saw that we already have one in there, but I always prompt a question first, if that's okay. We'll start there and then answer questions from the audience. So, my prompted question this time is, what can clients expect when they start this ATS strategy with Malecki Financial Group? And what might that look like?
Go ahead, Eric, you kick it off. I can maybe add.
So how to start this process? It would first, honestly, we'd go over this, this webinar, this slide deck, kind of just explain high level of the philosophy, and then we would get the statements of your assets that you have available for retirement. So that's not just your investment assets, but also we like to put, what's your social security number? If you have a pension, what's your pension number? So that we can show you, um, you know, obviously we're going to show you how much we think we can generate income from our asset management, but also we want to display, okay, so that plus your Social Security plus your pension, this is what you should expect over a 15-year period from an income perspective. So we collect all that data. We would build a custom plan to you. There's some clients like you saw on this one. I want to set up ATS, but I'm not going to start taking income until 2 years after. We have others that want to start right away. We have others that, for whatever reason, not fans of annuities and don't want to have that lifetime income segment. Either way, we build a fully customized rough draft one version of your retirement income strategy. We then have a follow-up meeting. We go over as many and we make as many rough drafts as we need to fully align to your specific needs. And then from there, it's doing paperwork via DocuSign, getting all the accounts set up, and then we usually generally meet either once or twice a year at minimum every single year to continue to see the progress and the growth of your strategy over the years. And we're always here for any one-off questions or assistance in between that time. But that's kind of what it'll look like.
Perfect. Yeah, it's always about meeting the client's objectives, trying to, maximize what they can be doing, making sure they're not taking too much out of their income strategies, like we talked about, kind of sticking to a strategy. And this is a discipline exclusive strategy that we have available here at our firm with the software. So it's helped a lot of clients, and we really enjoy the consistency of it. And it's totally a strategy. It really assists clients. And like I said, give us a call if you're interested. We can always run proposals, ideas, no obligations, and things of that nature. We're here to really serve and help our clients.
So we do have a couple of questions in the chat. I will pop them up so you can see them as well. But knowing that the strategy is completely custom per client, they might be a little complicated to answer. But for example, as this one asks, how would you necessarily change the strategy if somebody wanted to spend more during their retirement? They wanted to withdraw more. What might that look like? Where would those changes be? And I can go back if I need to for the other slides.
So if someone wants to, take out more money, of course, at the end of the day, we're just putting out an opinion, we're giving our opinion, but it's your assets, you can do whatever you like with it. If someone's trying to take more so that, maybe they worked hard, they want to spend it, they want to enjoy it, and, don't have to pass along as much as, you might think. We can increase your income. That's, definitely something we can do. The only issue is just we don't know exactly when your time's going to come. We don't, and no one knows. No one knows exactly when your time's going to come. So it's hard to plan for a strategy where we're going to have all your assets depleted at a certain age because we don't exactly know if you're going to live to you're past that age. You might, you definitely, might live past the age. So for the people that are more on that edge, which we definitely have a number of them, we will try to push the limits of how much income we can squeeze out of it. The main concern we have is that, so generally we use 15-year periods for income strategy. After the first 15, we reset, we rebalance the buckets and move on for the second 15. What may happen if you want to push the limits of how much income you're going to take, what may happen is that after we do that initial reset after the first 15 years, we your standard of living may go down because of just how much income was withdrawn in those first 15 years. Or if you may risk running out of money. It's kind of funny just with financial planning. A risk for us in managing our clients is someone living a very, very long life, but in a
Mhm.
normal world, we always hope someone does live a long, happy, and healthy life. But we have to plan for you living a long life because that means more years of income we have to provide for. And so, obviously, we can get very custom with people. We can push it to the limits as much as we can, teeter on that edge of the like, we're taking out maybe too much income, we might run out, or we're taking out just the most we possibly could. So we obviously can do projections on that.
Yeah, keep in mind too, this is flexible. It's not a set in stone. If
No,
this is this
no.
flexible strategy, we've had clients tell us reality stories. Hey, I don't need 4% income. Can I take less? So we've structured it that way. Some clients might take 3.5% withdrawal rates and things of that nature.
Yeah, and
So flexible, very flexible strategy.
yeah, and on the opposite end, we've had clients said I've worked 35 years very, very hard to save my money, and now I want to travel the world. I want to enjoy it, and I'm okay with risking it on those last several years, potentially of my life, in my 90s, maybe getting towards the end of my nest egg. And so it's a fully customized strategy around the parameters we described of three buckets with five categories within it. But it's flexible and adjusted to your customization.
Yep. And sometimes, hey, sometimes clients, when you're younger and you first retire, they may travel more and spend more money. But as we age, we might not travel and do the things we can early on in retirement. So then we're flexible with that, where maybe you're taking out more income, but then you're dialing that down, 15 years into retirement or so.
All right, we do have another question, and this is kind of more about a planning timeline. So,
Okay.
if someone has restrictions, they can't move money right now, they want to do this strategy, but they need to wait. How soon before retirement or during retirement should they meet with you in order to set up this plan?
So if they have restrictions on not being able to move the money or have us manage it until retirement, what we you could do, we still could do planning. We could build this plan up and give you recommendations on how to allocate it in a similar bucketed way within your 401k or 403b or whatever type of retirement plan you have. It's not. Yeah, obviously it's not gonna be as smooth as having us be able to manage it and have our hands on it, but we can at least build your advanced time segmentation plan. You have it, and then you, or with our help, you try to allocate it according to those buckets within your 401k. Stan, any other comments you think
Yeah,
from
no,
your end,
I
or?
totally agree. I mean, I think it's kind of like stage one. Like if you are restricted, yet like Eric just said, maybe we can assist and try to get some things in alignment for when you are ready and maybe 5 or 10 years out from retirement and really maybe implement the full strategy when there is no restrictions.
Yeah, I'd say for someone, let's say that didn't have restrictions, I generally think once you're in 10 years of retirement, that's when you can start getting that ATS set up. And for those that do have maybe access to in-service withdrawals with their 401k, they then sometimes tend to wanting to, hey, let's get these buckets up now. I'm going to do in-service withdrawal, a rollover, and now and have you manage it. But at the very least, once we get within 10 years, that's when we want to start kind of building it. Because especially also if a client has in mind, I really hope to live off of X amount of dollars in retirement. That's what I'm really hoping for. Well, waiting to find out if you can do that the year you are retiring is usually not the best case. And so that's where it's like if you start looking at 10 years beforehand and hey, maybe unfortunately we're not on track for you to live off of that dollar amount you really had in your head. And so we can make recommendations like, okay, all you got to do is save X amount more every year over these next 9 years and so on and so forth. So that's kind of what we see in general.
Yep, exactly.
So, I'm not seeing any other questions in the chat, so I think we are probably good to start wrapping up. Don't worry, we have other ways for you to reach out to us and get your questions answered. But if you're ready for the next step, that is what we're here for. If this is a strategy that you're interested in and you want to get started as soon as possible, keep an eye on your email because you're going to be getting a follow-up email from this webinar from us. And reach out to our office. We're available via phone, email. We have a scheduling coordinator that can set everything up. We have a Calendly for online if you want to book a meeting. We are here to help in whatever way that we can. You just have to reach out. So I think that is it from us today. Thank you so much for being here with us. Again, if you have any questions, just shoot us an email, call the office, whatever we need to do. And we look forward to talking to you guys soon.
Thanks, everybody.
Thank you.